Good morning, beautiful people of the internet, and welcome once more for our Sunday special. Joined as always by Adam Lawrence, Helen Chorley, Piotr Rusnek, and we have back recently with us, hopefully never to leave again, Mr. Ross Harper, and myself, Jay Howard. We'll be talking about anything that really interests us and that we hope interests you. If you haven't read the Sunday supplement, what have you been doing with your coffee this morning? You haven't been watching the BBC News. You haven't been listening to LBC. You haven't been listening to GMBG News. You've been reading the Sunday supplement. Be honest with yourself. I'll be honest with you. You be honest with me. Everyone's read the Sunday supplement, right, guys? Show of hands. I read it. Who? I see porky pies.
It's so good. I read it twice today.
There's some kind of arrangement between you and Ross is there. So you read once for you and once for Ross.
So there is a quantum in the group of it being read technically as many times as there are people in the group, so which is good. But if you do not know where to find the Sunday supplement that Adam pours his life over for one of the 7 hours in the 56-hour days that he has, then you can find it on the Partners in Property Facebook page, on Adam's Facebook page, on all of the Partners in Property hosts page. It also gets put through maybe 15 or 20 WhatsApp groups. That's how I know it's live. My WhatsApp just explodes in the morning. And it is most likely going to find its way onto a couple of property-specific Facebook groups as well. So there is no reason to miss it. Adam's précis or Cliff Notes, which take approximately 68% of the call. But let's go for the Cliff Notes. And as always, we'll jump in with our thoughts and feelings on the subject of the day. And we will invite you, the listeners, as always, to jump in with your questions, with your views. And don't be afraid to argue with Adam. He is a very forgiving person when it comes to other people's opinions, whether he agrees with them or not. So, yeah, let's get into it. Adam, take it away.
68% of the time, every time, Chief. Thank you for the intro. So it was one of those this week where I was going to write about something completely different, but just had to be palmed off for another week or another month or whatever, because obviously a little bit happened this week. I was following it. I was actually enjoyably enough on holiday, relaxing whilst also laughing at the amount of lying that was coming out of Westminster. Like, oh yeah, I've got 100 nominations. Have you, mate? Have you? I don't think you have. Have you really? It doesn't look like you have. So it was fairly obvious once. Incredibly, Suella Braverman tipped the balance, I think, with one of the great political plays of modern times. And she's got away with it scot-free with no backstabbing chat, unlike Sunak did when he walked out on Johnson. But there you go. That's politics for you. So I think that was the moment when we knew it was all over. And the great Shiva that is Mr. Sunak ascended to the throne and into his rightful place as the least idiotic idiot in charge of the Conservative Party for some time, which is probably hopefully we can say a bit better than that in sort of 3 to 6 months. So Rishi's in. He came in with a complete non-Johnson style, rather than coming in and saying everything's fine, crack on as normal, levelling up, blah blah blah. I'm just off to go and go back to the Caribbean or whatever. He came in and said Britain is facing a profound economic crisis. And I thought, blimey, mate, could have at least, said party at mine tonight or something, bring your own cheese and wine or whatever. It was all a bit miserable from day dot. And I thought, blimey, this is bad. Maybe worse than I've been thinking about and talking about. And of course, we haven't seen any proper figures yet from the one government body that's tasked with doing that, which we will do in the next few weeks. We had a bit of chat about it at the time back in March, because actually things were far, far better than 2021 had predicted that they would be by March 22. But if you recall, Rishi didn't go into the locker and start spraying that money around in the club. He didn't start giving it the old, doing any of that. He kept. We had something like 150 billion quid more than we thought we would, and he spent about 15 of it and kept the rest in the locker, and laid the groundwork for some of the ways to get through what he was concerned about with energy, with Ukraine, with all of the rest of the situations that have been bubbling for some time now, with inflation in general. So came in and gave it the big thumbs down. I did consider whether that was just because he wanted to look really good when he sorts it all out, but I think he's better than that, and I don't see the political point scoring in doing that. But I'm politically naive to say the least, really. So I'm maybe not the best person to ask. And then it made me think back to this moment that I've sort of mentioned briefly in passing before, but I decided to really expand on this time round. So I've done a little timeline of just a little reminder of when the lettuce ascended to the throne, and just quite how badly her administration screwed everything up. And then a resultant Bank of England meeting, and then a question, an innocent question from a keen and fresh-faced economist, let's call him, the Parsley of Paisley, or whatever you want to call him. And, the question was simple enough. I just didn't think the Bank of England stress test that they published was particularly a stressy situation, specifically on the base rate. They'd done this test under the fact that base was going to go to 6. I've said publicly over the last several months, I've got some concerns it's going to go higher. Not that it will do, but it could do. And once the inflation horse is out of the gate, it's notoriously difficult to rein it in. There's all sorts of historical evidence behind all of that. And I got told off / mugged off in public and live on the internet, really, for asking this question. I didn't really get much of an answer. I just got an answer that said, "Nah, mate, we've got it right. Shut up," really. And I just thought, I don't think that's really good enough for the Bank of England to. And then that was the day when the Bank of England stepped in and said they were going to buy the long-term bond yields. And on the day, it sort of became clear to me that that's why he'd been quite so brutal with me, that he couldn't say in that 8 a.m. because we could have front run the markets, which would have been nice, to be honest. But obviously he couldn't tell us. Obviously he couldn't tell us that was going to happen, and then it did happen. So I then didn't think too much more of it until our great leader said we're facing a profound economic crisis on Tuesday this week, and I thought, I'm worried because I'm not so sure. He was so sure, and the more sure someone is, the more I know I'm a difficult bastard as well at the best of times, But when I always Jay's surprise on his face, but I do think the more sure you are of something, the more you should be questioning it. I'm not talking 2 + 2 = 4, although you can argue about anything these days. So probably we could have an hour on that one time if you want to. But I'm talking, this idea that the world can't get to this stage. The UK economy is weaker than it's been in terms of the global positioning of the UK. The whole sort of Truss and Kwarteng proposition was coming in saying, well, we're the United Kingdom, and we just got blown aside like a leaf by the international bond markets. And people forget the power of the bond markets, because the bond markets haven't been very active for 15 years. They've just been dribbling down and trickling down in this bull run. But when $375 trillion worth of liquidity decides it's going to do something, good luck standing in the way of that one, mate, because it reminded me of 1992 and when we left the ERM in utter ignominy, when it was like, we will defend sterling, and George Soros is like, will you? Not sure you will, mate. Not sure you will. Here's a couple of billion that says you won't. What do you reckon? Oh, by the afternoon, he's counting the money. He's counting the money in Monaco or whatever, the man that broke the Bank of England, if you recall. And a little bit of this current scenario reminds me of all of that. So I've got my concerns around all of that lot. And then I went into some kind of bizarre rant about binary things versus not as in binary, non-binary. We're not going to get into gender reassignment and all the rest of it for this hour. That we'll save that for the second half of the podcast. But just about what everyone wants it to be, Rangers or Celtic or whatever. Whereas the reality is, you know, some of us don't participate in all of that stuff. And I made the example where I live, you know, it's Birmingham City or Aston Villa or forget the rest. You know, I prefer Solihull Moors, dear boy. I prefer Solihull Moors, much more cultured down there, you know, much more cultured. But the reality is life isn't binary. You can try and make decisions as easy as you want, and you probably miss quite a lot of stuff if you do that. And some utter weirdos like me actually enjoy things that are complicated because there's beauty in complication, in my opinion. It's not about unnecessarily complicating things. And I seem to spend a lot of my time trying to uncomplicate things that are complex to try and explain them to people. But
by complicating them again.
And then you wouldn't know because you don't read it. So I don't know how you can comment.
It's complicated.
But the point is, really, what I got down to was I was feeling pretty bullish. So I thought, right, I'm going to make a prediction because I know there's a lot of people out there at the moment watching the 5-year fixed limited company markets. And I know that from the hundreds of deals that I've been involved in, when I get the insight into financial arrangements that vendors have locked themselves into, 90% of the time they're fixed, even in a time where it didn't necessarily make really strategic sense to fix, right? And sometimes they've been paying too much money on some of these loans, and that's been the reason for the sale, right? Now, at the moment, you've got people saying, well, they might have to have a variable rate loan, mate. Now, people don't want variable at the best of times. Most people, 80+% of people. So do you want variable at a really bad time? Well, that doesn't make sense to me. Now, I've ridden the variable wave for years, and I've nicked a couple of quid on the back of it. You know, I'm happy with that. And at this stage, as you all know, I've been banging on about fixing for about 9 months, and I've been doing a lot of fixing. And just because the rate's gone, and you know, yesterday all my troubles were so far away. I won't start singing because it's only 9:15. But although you know I love a bit of karaoke, but it could be worthwhile looking at fixing, and I think we're going to see some 5.75 before the end of the year, limited company 5-year fix. And a lot of people might still be choking on the cornflakes at that sort of number. But my point is, if you can see it, if you can take it, some of these loans take they all take months and months and months to complete anyway. If things keep dropping, you can probably switch your product or switch your lender if that's what you want to do and switch down. If things stay volatile, which seems highly likely to me, stay volatile, then you might be quite happy you've got that 5.75 locked in. Defend, set the cash flow, sweat the asset harder, asset management, layer on. You never would have in 10 years heard me talking about how much I'd advocate going into things like HMO or serviced right now if you want to hold on to your assets. But this is the devil's driving, and needs must when the devil's driving, right? So you've got to work harder to get the same returns that you've had over the last 2.5 years, which doesn't ever sound appealing. But anybody who's been holding any property, even if it's one house that you live in as you're listening to this, anybody who's been holding any property has had an absolute bloody gift from the heavens in terms of the giant amount of stimulus that's been dropped into the economy. Great. Cash up, get over it, defend it, then get on with buying some new good stuff and creating some new money, as we've talked about before. And that, ladies and gentlemen, 68% of the time, every time, is that. I'll hardly say another word during the whole of this, I'm sure.
Oh, gosh. That's a prediction I think we can dismiss instantly, I think. Go on, Ross.
I was saying that was beautiful and succinct.
You mentioned there about predictions, Adam. This is a really interesting one. I think I heard some really good predictions yourself earlier on in the year. Rod didn't really make predictions, but more educated guesses and more what you would expect rather than predictions. I think predictions might be too strong a word. And then you get similar from like Kwasi Afum, not Kwarteng. I haven't spoken to him. And like Manish
Hashtag
and
the one real Kwasi. Yeah,
that's it.
absolutely.
Will the real Kwasi please stand up? But you know, you and these were quite realistic things that you can expect in a reactionary market, because when there's tumultuary in the marketplace, it reacts. It doesn't really predict. But I think everything everyone has said or anyone has said in the last 6 months, barring the most practical advice, like try and get onto a fix, very practical advice. Everything else has just been cast to the sands. Everything else, because no one could literally predict the Truss Kwarteng duo of utter destruction that kind of entered the marketplace. No one could have predicted that. And apart from the death of the Queen and Nostradamus, who did predict it, no one could have predicted anything in the last 3 months, right? So it makes it difficult to perceive what's going to happen, you know, even in the next 3 months. I think it is clear, you know, talking to yourself and some mortgage brokers, you know, it's going to be between 0.5 and 0.75 as a jump, you know, next week, and that's a reality. But then, you know, what does February, March look like? You know, what does year end in April look like? Because that's going to be a real kind of teller as to what even 2025 is going to start looking like, because 2022 only really comes to an end into like business year end in April. You know, that's when we're really going to start to see who's been deeply affected by all of these changes. I was myself and Piotr, we ran an event Thursday and Friday, and we had solicitor come and speak, mortgage broker come and speak. We had David Sanderman from EIG speak, and there was basically everyone, including the auctioneers that we speak to. I saw sight of an internal email between a large auctioneer chain recently, where they had proudly announced that bank repossession instructions are up 300% this quarter.
Wow.
And everyone else that we talked to,
If
is
they go
hearing
from
the same.
3 to 9,
Well,
Yeah.
that's it.
Well, actually, the number was somewhat higher than that, but it was not in the hundreds. But it was a fair chunk higher.
So we need to watch our base year effects, I think. But the one of the things that Rod's most recent Rodcast with Mike Kovacs is a really, really good one if anybody hasn't listened to it, because he says a couple of really sharp things. One, a really good reminder that when you have a recession, your number one job is to hold on to your assets, right? Which I found a really, really good, timely reminder of that I thought was worth repeating however many times to whoever would listen to me, right? But one of the other things that he says that is a really, well, he says, I mean, don't get me wrong, listen to the whole thing, because he says lots of stuff that's really useful. He's an experienced guy who's done lots and lots of investment and development. But aside from the point around holding on, he also talked quite a bit about the point. Well, when to go back to 2008, let's say, if the bank in the good old days, right, the bank lent 100% of the money against an asset or whatever, or even 100 and 105, 110, whatever.
Yeah.
So when the asset, which had been valued by a surveyor who'd been bullish, let's say, at 30 million, had a loan on it of 31 million, when that value dropped to 20 or 25 million, it wasn't immediately attractive to swipe that asset because there'd be a massive write down. And one of the big jobs that the banks did between 08 and 11 really was to try and not write down as much as possible. Didn't work in somewhere like Ireland where it just collapsed and it was 10p in the pound or whatever. But they actually did quite a job in the States and the UK in holding the values up. And that was the system protecting itself to a large extent. Now, if you then fast forward to these days where it got valued at 30 million and they lent 22.5, let's say 75% of value, right? If that drops to 25, yeah, then it's still relatively attractive for the bank to swipe that asset. Maybe they lent 20, maybe they lent 15, right? So there's still juice in it if they swipe it to repossess it. Now, that to me, translating that means it's quite repossession's a fair bit more attractive than it was in 2009 from the lender's perspective. And boy, oh boy, is that a pretty dangerous situation.
Yeah, I mean, the 2008, 2009, when they really didn't want to crystallize, and it would have been a crystallization because
Exactly.
the lending was at full market value and then some. You know, you could get 110, 115% mortgages. So if they were repossessing, it would have been 100, it would have crystallized the debt. They would have been. There you go. Just, there it is. It looks like a little mop head, doesn't it?
Oh, Hugo. Oh my God.
What did you say hello? Sorry, he was barking.
A while ago in the German World Cup, there was an octopus that was predicting the scores, who's going to win. Can we get the dog to predict the base rates?
0.75. I give a wee bit lower. Clever dog, isn't it? Clever dog.
He'll do anything for likes, won't he? He'll
That's
do
it.
anything.
Absolutely. Kids doing flips into swimming pools.
Dredging up a deal from 4 years ago, anything for likes. This guy, seriously.
Because as soon as I sat down at the screen, Lisa started phoning me, get the dog off, get the dog off. Get stolen.
As a comment from James, question actually, we're seeing more reductions at commercial auctions with stock by receivers, specifically bridging lenders. Some say commercial leads residential. Is this what you all saw in previous cycles?
Not exactly, no. So the statement that commercial leads residential, I think, is a bit of a it's not enough to say that, because if a market starts to deteriorate, it's the commercial asset values that drop faster than residential asset values. And when a market moves into positive, it's the residential values that move faster than the commercial values. Now, commercial values are difficult because, you know, I know some commercial property trainers will say 100% of the property's value is in the quality of the lease, but probably more like 60 to 80%, right? It's not the whole thing. In this market, like during COVID, there were some commercial assets that were bringing in a massive yield that massively still dropped their value. You know, because people couldn't go out, people couldn't use these services, people had to do everything online. So all of those businesses, you know, the downgrading of those covenants on the commercial lease basis really affected the value of the assets, the multiplier of the income, everything. You can get on the phone and talk to someone like Christine Janaway about how you would use different valuation models to add some certainty and some clarity around what that commercial asset is worth. But no, commercial is always more volatile. Residential is far harder to move in any one direction. The main thing that really affects residential values over a period of time is major employer or employment in the area leaving, closing, reducing. Schools moving down Ofsted tables tends to really be a big issue. Loss of amenity space tends to be a big issue. An area that loses or reduces its transport links, so whether that's local bus routes which go from twice an hour to once an hour, that does have a median effect on property values. So yeah, it's you are seeing, I think James, first part of the comment was correct. You are seeing more price reductions from the receivers, and receivers can move prices far quicker than banks can. Banks technically have to wait for the property to go unsold, then they have to get a surveyor out to come back out again and then revalue the asset if they're going to value it down, and they'll move that on the 90-day value. But yeah, there's definitely some of that happening now, definitely. I mean, it's interesting your point, Adam. Before you disappeared off, this time round, I think the banks have been really smart. I mean, if you pick up 100 property investors and put them in a room and said, okay, put your hand up if you can evidence to me right now that your property has been down valued by 10% in the last 6 months. How many of those 100 people are sticking their hand in the air, and how quickly are they doing it? All of them. Maybe bar one, and that one person only bought something a year and a half ago, right? But if you bought something in the last 6 to 9 months, chances are you've been down valued by 10%. And the highest really valuation you're getting at the moment is 80% LTV, right? So the bank are now sitting there on a cushion of 30% of equity, right? Because they know if they have to drop this into an auction at a 20% discount, there's going to be a 10% buffer sitting there, because there is still a shortage of homes. There's a shortage of places to rent and live. And that hasn't changed. And it's not going to change for a very long time. I left that on a kind of final point, but thoughts are invited.
Yeah, I think that's a really good one. And if you think about how many people are also, and I kind of sort of alluded to this point today, that they've also got to just put things into context. I mean, if you live in Surrey, yeah, and your portfolio's around there, well, on the bright side, if it's an established portfolio, you probably didn't have 70% LTV in the first place. Even that every time you get valued, you still get chipped. And then if you put on 30%, 25% in the last year or so, that's 2.5 years or so, you know, your 70 or 60% is now down to 40 to 50. So you can still just about get that rent coverage. But the problem as as people who will want to sort of simplify it very much, the problem will be you might be sitting on a 40% LTV, but not making any cash flow. And then it's like, well, and then if these fees in the products are going to be 4% in order to try and get the pay rate down to make things work, and that makes, to my mathematical brain, that makes sense, but it feels punchy. Then if the market's fragile, how much capital growth of the next 5 years are you giving up? You know, strangely, Jay, I totally agree with what you just said, but the last sort of 3 or 4 valuations we've had drop in, and we are punchy, because why not be punchy? You know, no one ever up values, although we did have one up valued this year. The second one in over 1,000 valuations we've had done, the second one ever that got up valued. So that shows you there was a bit of bullishness in the market.
Black swan economics sitting in the background there somewhere, right?
Clerical error is like 2 in 1,000 or 2 in 1,500. Clerical error has got to be considered, quite frankly. But surprisingly, you don't phone up and say, are you sure? You just go, that's what it says, so let's just crack on with the product. Thank you very much. But the last 4 or 5 that have dropped in, because I've hit our punchy numbers, because the type, and this is the part of the beauty of property, I think, for me, the numbers that RICS are using are between 2 and 6 months old, generally speaking, for their comparables. Those deals were therefore done, you know, between 5 and 9 months ago, crest of a wave stuff, but also the mortgages that were applied for were at the 2 and 3% sort of level, right? So those all come to fruition, and the length of the cycle's been extended. It's been taking more than 100 days on average to get stuff over the line for the market as a whole, etc., etc. So this is actually, I would argue, the absolute peak time to value a property, as long as you haven't got a loan to value covenant in there, right? So nice, simple, bog standard 5-year fix, the ultimate time, but a crap time because the rates are so bad. So that needs to be borne in mind. It would be nice to see the market giving a bit more discount for the lower loan to values at the moment, because I think the logic, your 70% LTV logic there is bulletproof. But if I'm the chief risk officer, let's just say that would be such a job that I might take. If I'm the chief risk officer, right, I'm going, look, I don't really want money out the door at more than 60% at the moment, guys. So however you package that, however you do it, whether you lean on the surveyors to chip 10%, as is the very, very standard practice, whether you do this, whether you do that, or whether the product team come out with some attractive stuff at 60 and 50 LTV, then that's what I want to see. I want to get the average book down. Remember, a lot of the lenders who will, look, lenders are going to be at risk here. Applications are off a cliff. There's very little of want. The brokers, who are normally pretty good salespeople, to be fair to them, are not making the most comprehensive arguments on social media, or they're not really making a lot of noise at all. They're quite quiet at the moment. And they're all sitting back a little bit thinking, well, bloody hell, we've had a hell of a year. Almost everybody has broken their record year that they've ever had, right? But the boys and girls at the top of the organisations will be sitting going, you know what, guys, 2023 don't look great at the moment. So rattle the jar, get the pipelines going, get some stuff out there. Or, I said in the supplement today, just for Ross's benefit, because obviously everyone else has read it, I said today, they'll be looking for mergers and acquisitions suitors. You know, the smaller package lenders, they've got the highest cost of funds. Now, they may well have quite good tech systems that keep their operational costs down, but they can't lend it out cheaper than the swap rate. Then they've got to add the OPEX. Then they've got to make some margin. So the choice is going to be change where they get their funds from. Right now is not the time to go, oh, hiya, we're quite a small lender, but I think Goldman Sachs, we can get 500 million out the door, because Goldman's are going to, oh, rightio, can you? Well, here's the rate, guys. So, and there's a non-utilisation fee of a princely sack on that money. So if you don't use it, you're in trouble. So you're then at the stage where you're going to have to look at shrinking your business, which nobody ever wants to do, selling your business, which rarely the people want to do, unless it's on their own terms rather than forced on them by the market, you know, or a face-saving merger or similar. So, you know, this is why people have got to be fairly hard-headed in this situation, but also, you know, keep the brokers on speed dial, and the brokers will be there hungry for business, just like relatively soon the agents will be there hungry for business, because transaction volume is dropping. And this is the classic, isn't it? When you talk about leading indicators and lagging indicators, it's the transaction volume dropping that tells the story. People are obsessed with the price, but it's all volume really that we should center our attention around in these situations. I see.
How do we know transaction volumes are falling?
Say again, sorry.
How do we know transaction volumes are falling?
But from talking to the brokers, certainly in terms of remortgage transactions.
I guess that's the kind of thing that where you go into the
remortgages you're talking about.
No, not just remortgages. I mean, sales. Yeah, there are transactions are down quite significantly. Now the trouble is, you know, year on year, July 21, stamp duty holiday, etc. You can't do particularly good comparisons.
Yeah.
But volumes are still. This is part of the COVID statistics problem, right? Everybody says year on year. Then there's a problem with year on year, just like you said with the repos earlier. Did it go from 3 to 9 or whatever, right? But then you've got another problem, because you go back to 2019, but you can't treat 2019 like it was a normal or functional market. All we think in our heads is it wasn't a pandemic, right? But if you remember it, it was quite a difficult year. The market was quite flat. And then within the last 3 months of 2019, there was an election, and Jeremy Corbyn was in the shaker. So a lot of people got scared, and a lot of transactions fell at that point as well. And then they picked right back up when Boris was elected. So the base year effect side of it is quite hard. But you know, Ross, transactions have been trending down for the last, 20 plus years, generally speaking, as prices have gone up. As a general rule, it's been a curve going downwards. Transactions were up, 300,000 a year on the average between over 2020 and over 2021. I mean, 2020 there was a lag because of the time when the market was closed, but there was still more than average transactions in that year, even though they were transacted over 9.5 months, probably realistically, something like that. So in a way, volume was up 33%, even if transactions only held steady. And the trend this year has been very much more normalised and trending downwards. And if you just going on what these guys have been saying about auction and how much has not been offered to the room or the internet or whatever, though we're looking at what 40% sold in terms of what's been lotted in a fair few of the bits and bobs recently.
40 to 50%, yeah.
So do you guys know when you'd have to go back to find that 40 or 50% in any volume over the past 15 years, 10 years? Is it the lowest we've ever seen? What's the context of the data there, guys?
I mean, the difficulty here is that if you go back less than a year, maybe even the beginning of this year, you were still, if you took what they brought onto the catalogues and what they had sold, the majority was still covering, mid 60s was, that's the full undoctored figures. But they were still operating in catalogues, for the majority of auctioneers, their catalogues are under 50 lots an auction. Then you have the top 10%, which it's 100 to 200. And then you've got the top 1% where it's everything over 200. And at the moment, we tried to put something into, we were problem solving. And we tried to put something into a Barnard Marcus auction, which is not something we've done for some time. And you can take from that what you will. But they said, look, we're not taking any more lots, which is not a Barnard Marcus thing to say. These are...
And the reason why they said they wouldn't take, because it would take 8 more minutes to offer our lot on the day. And they have 450 lots and they want to finish the auction one day.
I don't
450 lots. I've never seen that.
A 450 lot catalogue before.
Yeah,
Wow.
especially doing it live and on one day.
And how do they know yours will take 8 minutes?
Well, it was 2 lots. Question. So every single so on the workshop we did on Thursday, we had David Sandeman come around and actually show what the auctioneers see. And one of the metrics that the auctioneers get to see on their auction, what did he call it? Not desktop or
panel, yeah.
On the auction panel, is it will show them the average runtime per lot.
Yeah. Yeah.
So Barnard Marcus obviously know that they're running at a 4, worst case of 4 minutes.
And that's super efficient because they're like, okay, 250, 225. Okay, you're bidding. No, okay, no bidding. 225 then, and once, twice. So next one, and they're like that
What you're
efficient.
saying basically here is Adam would never become a Barnard Marcus auctioneer.
Essentially, yeah. I think he's out. He's out.
8 minutes.
I'd be good at that. That's how I did the HMO awards. Bang, 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 bang.
Yeah, you could apply for a job there.
She really, you'd be awesome to, especially if there was a bar we had to go to afterwards. Absolutely.
Just need the right incentivization. Yeah.
It was a work of beauty. Even with the both people like me coming up for a chat, she just gave me this look that said, "Look, 2 sentences, pal. Otherwise, you're off."
There's a question from Dominic. Do you think there will be residential commercial property price increases within the new government investment zones?
Oh, that's a difficult. Well, look, the reality is they mentioned Freeport shortly after Brexit, and I don't see any of those areas have massively increased in value in that time. And we're talking a good period of time between Brexit and now. So it may be that there'll be some...
I think it would be more specifically target. Like you need to know exactly what to do in those zones to benefit from like some it won't be just like buy the property and it will increase the value automatically because it's the investment zone. You have to like invest in the right sector, in the right something, and there has to be quite a lot of factors. You have to be quite clever about this. My opinion.
It's a difficult one to get a gauge on because even with the Freeports and these investment zones, even when the HS2 came out or the new Elizabeth line was coming out and people were expecting the price in those areas to jump, once the news came out, maybe there was a little bit of a foray and maybe there was a little bit of activity, but not enough to change the landscape of those areas for a significant period of time yet.
I would I would have thought it would be if you've got price pressure generally coming down, it just might be a little more supportive of that downward pressure. So maybe you won't get things drop as much because people will buy in with a view to taking something longer term, but increase. I don't know.
Yeah,
Just yet.
it may, like you say, it might support a resistance level,
Yeah.
and that probably makes more sense.
Interesting. Next question. There's quite a few questions today. What do the panel think the private lending market is looking like? I think we pretty much answered this, right?
Yeah.
Or not?
I mean, I spoke to
Some
someone
extent.
who gets lending from a family office on a fairly regular basis. So that's kind of between private and institutional. They fill a really interesting little gap there. And what they've said is they've come out and said they are not looking to lend on any property that's over £400,000. They're limiting purchase price risk to below £400,000. They've obviously done some research on their own numbers and their own trends, what they've seen over the last couple of years. And they've noticed that any property they've lent on or over a period of time, over £400,000, the chances of it making money is far less than the properties they've been doing at like 200, 250.
Well,
And
do you
some
know,
of them have even
that's
lost money.
fascinating, isn't it? Because someone the other day made a broad brush statement at one of the partners in property meetings, and I just couldn't let it go because you know what I'm like. And they said, these sort of houses above, I think the number mentioned might have been sort of £1 million. Well, they've trebled in value over the last 10 years, whereas the other ones have. And I said, look, I'm sorry, but there's just absolutely no evidence for that to be the case at all. In fact, terraces and semis have smashed detached reasonably out the park over the last whole number of years. Plus, obviously, they yield more. So I'm afraid that's just fantasy. And the trouble is, things go to people look at these things at too shallow a level. So they go, well, they bought that for 600 and they sold it for 1.2 10 years later. And it's like, they did, yeah. But the building works they've done in the interim in today's market, it'd be about 450 grand. So, and the stamp duty on the way in was whatever it was. So actually they've made about 50 grand in 10 years, which is a crap return on the amount of money they've put in. So I'm fascinated because one of the things that I got dead wrong during COVID or at the start of COVID was I thought the middle class was going to take a bit of a beating, right? I thought they might get a bit hollowed out by everything that happened. This was pre-furlough, bear in mind. But I thought higher value property would be much riskier. And I thought that they might suffer. And of course, it still did well because people could cash up and move out to the seaside and do all those things they'd sort of wanted to do and work remotely and all the rest of it. And I'd missed the sort of second order effect of all of that motivation to move and what that did to the market. But the logic that I had back in 2020, maybe some of that is still sound now. And well, everybody's getting hammered, with the cost of living side of things, apart from the top, even the top 10%, I think, are feeling it. But until you get to the really, really wealthy, everyone's feeling it. And if you've got you've made that jump to the 600k house or whatever, and you've got the big mortgage, and it's a resi, so they're not Jay's logic of the 70-75% LTV. They're at 85 or 90 because they were allowed to. If they went for the 2-year rate, it's a big old jump every month as taxes creeping up and everything costs so much money. Suddenly they've got to find an extra 1,200 quid or something. And it's not even finding that every month. It's the fact that where's the light at the end of the tunnel on that front, And I could see why that portion of the market could be unattractive. So that's really interesting to know someone who's got obviously more research resources and a better handle on it than I have is acting in that way. Really interesting.
It's very interesting. And that, I take it that's kind of more from Midlands up rather than down south, because that wouldn't get you still much in the south, right?
That's very true. That's very true. I mean, I suppose the other thing about down south is a lot of the prices have not taken quite the rip-roaring takeoff that they've had in, where are the best performing areas in the last 2.5 years? South Wales, Scotland have done pretty well. Northwest has crushed it. East Midlands has carried on doing well. It's been a long, strong performer, really. Southwest has done well.
The Yorkshires have done exceedingly well. Yeah.
Say again, sorry, Joe.
The Yorkshires have done really very well.
Yes,
South
they've
Yorkshire
been
moved really quickly. And Leeds and West Yorkshire have really, and even in the last 5 years, have done exceedingly very well. But London, I mean, I used to do early days when we were writing the article for Property Investor News magazine. Are we talking about which areas were winners and losers? And London, I think in the last 18 months to 2 years, it was only really in an upward trajectory in the important metrics, maybe 3 or 4 times in that period. So over 2 years, maybe only 3 or 4 months were they, and even then they were at the bottom end of that leading part of the market. And people have been saying that for a while. Property values haven't really moved that far in London, but rents have. And so if you had and you hold, then you're doing well. If you're picking up, you're probably not going to get the very best out of the marketplace.
There doesn't seem to be a deluge of deals, though, does there? For London,
there's more stuff coming into the market.
What have you seen, Ross? Because what we saw over the last, if we took the last 4 weeks as a whole, probably 2.5 out of those 4 weeks, the phone's been ringing a ton. People are trying to get rid of stuff. Last week that calmed down. Now I'm maybe ascribing too much to the political side of things because I've been following it quite closely, but it does seem like panic, and then actually calm over the last sort of few days. But am I just making it what I've seen fit the narrative that I think is right, or?
I think it depends who you're talking to. If you're direct to vendor, that is fear, and it's instantaneous fear of we're really struggling just now, and they don't really understand what's going to happen with the economy, and they don't understand how much of an effect these things are going to have on them because they're maybe not as financially literate as they could be. So you've got those people who instantly go on the internet and what's my house worth, or the we buy any house type websites, how much will I get from a house now? If I sell it now, can I get out of the problem now? So they're definitely, the last month, 6 weeks has been that has been on the increase, but that could be, we kind of think that might be quite a lot of things, and certainly costs of electricity and gas, these spiraling costs have driven quite a lot of that for a wee while now. If you're looking at the corporate people who put properties into auction, we're massively up in terms of them doing it, and they have a fear now, and it sounds like an abject fear. They want stuff gone now. They want to make the decision now. Now that's whether, I think we discussed this last week, that's whether they have the excuse now to say, we have this, we can sell it quickly for 80% of value, and we've got rid of the problem. And even if the market starts to move next year, they can always go back and say, well, we made the decision in October or November 2022. If you remember, it's a complete shit show. Nobody knew what was happening. And that allows them to get rid of stuff. But certainly the auction inquiries for corporate stuff is massively, massively higher. In terms of private lending, it's been interesting because there's a few private lenders, there's a few finance houses that are based out in Dubai. So we've been around chatting to them here, and they are very, very fearful of what's going on in the UK economy. One of the bridging funders I had coffee with last week, he was just saying that we are really worried about this. I'm probably going to move home. So he's thinking he's going to move back to the UK, so he's closer to it. And he says we've basically just taken 10% off our loan to value. But we've told everybody that. So the people who are usually borrowing from us, we're giving them 10% less. But he said that seems to be quite a lot across the board. The ones that are not saying they're taking 10% less are basically hiding it and then vetoing the deals further down the line. So it's all about perception, because nobody's actually been absolutely hammered yet. But it seems to be, for me, everybody's talking about it. We're perhaps helping it or not helping it by open airing it. But the reality is, I think there's a fear of what comes into next year. And I personally just wonder if most people are thinking, well, let's see what happens, get Christmas out the road and make the decision next year, 2023. And politically, there's been no stability there. So you're quite right, Adam. I think this week it seems a lot better, but did it make any difference to the price of the Cocoa Pops 2 weeks ago as to what they are now? That's not had any major effect. We've all lived through it. I mean, I made some decisions a month ago to sell some of my 10 Pillars houses that Adam and I have talked about a few times, which is contrarian investment from me, which was that I was holding some big units, like £1 million plus units. I get totally going against the grain of any kind of clever investment, but doing it for the guy from Pip that is going to triple in value in the next 10 years. No, but it was just that there'll be points you can sell these big items and get great money. I put the final flat on my church onto the market, and I got probably 100 grand less than I'd hoped for, but I still got 30% over the asking price. The surveyor's values had come down 10% from what we'd expected 6 months ago. But I just took the view, I've got a big loan on it. I don't know how I can control that loan. It doesn't really fit just now with investment. And yeah, I can afford, I've got lots of businesses, so I can afford to pay the loan. And if I'm not getting enough rent in to cover it, it doesn't really matter. But from a perspective of what's going to happen with the market now, my view is medium term, I don't need that asset there. There's not going to be any value. And I think in 2 or 3 years' time, I can buy it back quicker. I sold my big industrial unit, which I started going into, got 40% more than I paid for it 11 months earlier, 12 months earlier. So that's a great return for no real work. Didn't really do terribly much to it. So there are great opportunities to make money selling assets you've bought if that's what you decide to do. But I think the big problem is everybody's making decisions based on their view of what suits them. It's not really necessarily data driven by other people being repossessed. You're not looking at people in your house, in your street just now, if you live in a 4-bed detached house and seeing houses empty or the way it was in 2009 and 2010. The perception is it might get that way, but who knows? I probably don't think it will, because I don't think the government can afford to allow it to happen this time. But again, everybody has a personal view.
Yeah, I mean, I agree with pretty much all of that. I mean, it's the problem with 2007, 2008 wasn't the fact that the property market tanked in terms of value in real terms. It could have done that. It was that there were no responsible lending practices. The Big Short, as much as it's a dramatization of what had gone on there, is actually not far from the truth, right? You had a couple of the cocky characters that may have been, characterized a little bit. But the reality is that there were subprime mortgages being floated about and stuck in the middle of, some really good AAA quality portfolios. There's not really any of that now. Where it does get difficult for people, and I think myself and Piotr were looking at something recently, and we're like, well, what's the? It was a property that was going to auction. Oh, it was literally on Friday or Thursday. We did a quick. Let's try and find a property at auction that someone on the workshop can buy, some practical steals. And it came up, it was a property in Birmingham, and they had a first charge mortgage, and then they had a second charge mortgage with what looked like a loan shark with a website. And they pretty much had everything stacked on this asset, barring equity release, right? So it's those kind of environments where it's not a lending issue, it's a financial literacy issue. And you'll all be more than well aware that even responsible second charge lenders don't take more fat out of the deal than is necessary now. Once they know their second charge, they still have responsible lending practices that they have to go through. So there is less and less of it in the marketplace than there was, 14 years ago. So in that respect, you'd expect far less of an earthquake or a tidal wave of these repossessions coming in. But where I do expect to see quite a few of them is the fact that there have been almost relatively close to zero repossessions that have been taken all the way through the process since COVID. And that's because there was, the kicking of the can down the road by the government saying we're putting a stop on all repossessions during this time. And the people that work in those industries, the asset managers, the repos, the courts, the solicitors, everyone that handles that, it's a backlog, and it will start working its way through the system. And I think Ross, you're seeing it your side. Those valuations or those valuation requests and instructions are up. And same said from the internal memo that I saw from that auction company. They're up, they're seeing it. And when I speak to other auctioneers, members of the auction house group, or I spoke to Strettons and Clive Empson and 4 or 5 others, they're all seeing the same kind of thing. Even auctioneers where they wouldn't see that many corporate instructions in a year, they're now getting. They may not get the instruction, but they're certainly getting the valuation request, and that's a big change from a quarter ago.
But then wait, how quickly, the bit that'll be interesting is how quickly those types of things affect the market. Because obviously Adam and I are going through multiple refinances, and some of the reasons for things not being financed correctly or not being refinanced, it's just down to the surveyor being a wee bit, I think, nervous about where things go. There's no reality to some of their valuations. You have 3 sales in a street at 85,000 and yours is nice, but it's valued at 75,000. It just doesn't make any sense. The lenders are all saying, no, they are not putting pressure on the surveyors. But I think the pressure they put on the surveyors post 2008, 9 and 10 and chinned them for the valuations of 2006, 7 and 8. I think that probably has an effect. I've spoken to a couple of surveyors about it, the guys who run the businesses, and they're saying, well, we don't want to be exposed for your portfolio. That's ultimately what it is. But it's not going to take that many of these things. If you look at Adam doing 1,000 refinances, 1,000 refinances, losing 10% in every property means you're having to come up with significant sums of money, or it doesn't take long for people who are not financially in a strong position just now, as a lot of the people who have refinanced in the last 18, 20 months won't be if they've not taken fixed rates. It is going to start this pool of property that the haves and the haves not. So I think we might be entering this market, and I think somebody talked about it before, where really good quality, there'll be a flight to quality, and there's a really good market for private residential houses in nice areas. And then we're going to have this market of maybe cheaper property, which is rented out, that is going to struggle to get valued at the right level to allow people to trade it. And that's the stuff that might start to then fall off. So if you're a big cash fund, you might be able to pick it up. And then refinance at lower levels. Because remember, we're all trying to expand based on 75 and 80% loans to value. But if you're buying something at 60 pence in the pound, you just might have to hold on to it for a bit of time to get it. So the medium term view might really be the right time next year to get into it. But just look at all the number of predictions you're making in that one statement. It's bizarre.
I think expanding through momentum or BRRR or whatever is going to be super difficult. But I do think, like, perversely, it will be a great time to expand. So that just means you've got to look at other ways you can expand. So I don't mean going to McDonald's or whatever, that's the way I normally expand. But I mean, find people who need to allocate capital, for example. That's another way of doing it ultimately. So you change your business model from what everybody's pushed on the circuit or whatever, to, right, okay, well, it still works at lower pricing, at higher rent. It definitely works, right? The way things are looking at the moment. So what does it take to get the financial muscle behind you?
Yeah. I mean, the other thing I think we're likely to see, the stickiness in the market is definitely going to start happening, which I think is definitely agree with what Ross has said there. You may something you're going to trade out straight away. You may have to hold for 6 months, try and add some value to market it in over a period of time rather than expecting a snap up. But this is one of the dynamics in the market that has definitely shifted. We've been talking pretty much all through COVID, what's driving these prices? These things are selling for monster money, and the market can sustain it. And this is what we were saying at the very early doors of COVID. And my response to that was, look, there is a lack of supply, and there is an overmark of demand. Well, what we're starting to see with the auction catalogues, bear in mind, we were saying last week, 3 London auctioneers or regional auctioneers are releasing their biggest ever catalogues. You know, we've now got Barnard Marcus releasing probably the biggest ever auction catalogue since
Ever,
records, right?
Yeah.
So when the supply starts outreaching demand, price starts to suffer, right? So and I think even if the price doesn't start suffering in the short to medium term, it will create that kind of slowdown and draw out of how quickly you'll be moving through deals.
I think it'll also show me how that information is publicised. I shared a post from you from an auctioneer that was off a Facebook post where, and we talked about this last week, 82% of the properties sold. Now, a year ago, that person would have shared 92% or 98% of those properties sold, but they're now accepting 82 seems good. And then when you've analysed it under your auctions workshop, you're saying, well, it's 82% of a figure because 60 or 70 lots were lost out the process to keep the percentages high. But I think what we're going to see is when some of the kind of quality things don't sell and they go through 2 or 3 auctions, that will become newsworthy. And I think that might then stop on the bigger units, the funds buying, it's going to stop banks lending because surveyors are going to be quite wary of selling something. My personal big unit was a 4-acre site with a 10,000 square unit on it, and it was mostly under concrete. It had a couple of other barns at a way station. It was a big thing. It was a really cool thing. And
is that you did the video walkthrough of that one? Like you found it at the back of something that you had? Was that like an old aircraft hangar looking thing?
No, that's something else. It was just a big flat bit of land with concrete, a shed on it. So always quite. I liked it because I'm used to 3-bed semis. But the reality of it was I sold that 6 months ago when things started to look as though they were going to get a wee bit scary. I'm just thinking I'd rather cash out, not have my money in that, and not worry about a tenant being in there, and I'm not in the country anymore, so I'm not that close to it. And I put it but I didn't even put it in the market. I mentioned to somebody that I might be selling it, and then I got 4 off-market offers for it. So it's absolutely incredible, and got a reasonable price for it because of that. You instantly, people are, so that market's hot, that market might stay hot. But it was quite newsworthy amongst all the surveyors because they all know what they're doing. But it's the same if something sits in the market for any period of time. The surveyors, it doesn't need to have sold to create that negativity. If it's a house in a reasonable street and it doesn't sell, then everybody just guesses at what the problem is. And the problem might just become lack of demand. It just could be there's not that person there to buy it. But it doesn't necessarily mean it's 30% less in price.
Yeah.
Interesting. There's a few more comments as well. And some from Kai. It's interesting that years ago, all mortgages used to be standard variable, now to 5-year products. But in the US, mortgages is generally fixed products for the full term of the mortgage. Interesting.
And do they bake that into the value and the rate, Guy? Is there, because that's a long commitment, because a mortgage can be 18 years, 30 years, or whatever. So is that baked into like how the rate is represented or how the asset is valued?
Must be.
You're muted, Adam.
So that's right. I was talking to someone else anyway. Don't worry.
Fair enough. I thought you knew something about the American market. I was like, oh, let's do this.
What's really interesting is what's screwed up the mortgage product market, let's say, over the last few months, is the fact that 5 years hasn't been enough time and has meant volatility. And I'm not saying there hasn't been volatility in the 30-year US, although there hasn't been that much volatility. It's just been a climb and a climb and a climb, generally speaking, over the course of this year. The 30-year US mortgage rate hasn't been anywhere as volatile as gilts for obvious reasons. Biden is vastly superior to Liz Truss, and that doesn't mean that he's good, right? But it does show you that the next 5 years, there are scenarios in which the next 5 years sees relatively limp capital growth, a relatively volatile path through all of that. And 4 and 5% fees are not what anybody wants, and you might be doing it for not a lot of money.
Can I share something? I'm just reading it just now. which is UK based, but it's a trader and a developer I know quite well, and he's got a big portfolio of low value ex-local authority properties at decent yielding. And he has gone to a mainstream bank. I won't mention them, but they're here. And he's got his valuation back. So I think there's 9 houses or flats, total value 635. And the best this mainstream bank can do, or what they're persuading him is the best that they're prepared to do, is on a value of 635. They'll give him a loan of £315,000, so 50%. The arrangement fee is 4,725, which they'll kindly add to the loan. They'll only do 120 months. They won't do any shorter than that. Rate is 6.86, and loan to value they're saying is 50%. And he said, but that's ridiculous compared to everybody else. And they said, that's what we're prepared to offer you. And in fairness to him, he needs to do this. He's got reasons he needs to get money out, or he needs to add more properties into the portfolio and do all these things. So he's been forced, and he's now actively looking, well, am I going to have to just sell these now? They're tenanted. Do we need to auction them? Do we need, there's a whole range of issues.
What's the break conditions around that, Ross?
No, I think
some ridiculous.
So you'll have to just buy out some at 5 and 6 and 7% over the period of time. I don't have the loan document here. What I've got is
probably like 8% early repayment and stuff as well, something like that.
That's somebody pricing themselves out of the market from the lender, from the bank's perspective. Absolutely. They do not want to offer that money. They are making it as bleeding unattractive on every single front, on rate, on application fee, on term, on loan to value, to go shoo away. Don't take this. Don't buy this product.
But they've taken him 5 months from starting the process to getting here. He's paid £3,000 in fees to surveyors. It's just. But my point is not about what they are doing per se for that one individual. But if that's what's going on in the marketplace across the board, we're in a bit of a pickle in terms of we don't all know that this is going on. It's a bit like me in 2008, 9 and 10. I remember I had a few beers with Adam a few months ago, and we're sitting one night watching The Big Short, and it just came to me that my predicament, we're sitting talking about it, and I was like, do you know what really was wrong with me? And he went, what? And I said, see, in 2007, I was getting a hunting license and stacking things up, and I could buy everything, bought a business partner, thought it was amazing. Meanwhile, these clever fuckers in America are betting against me personally with all their stuff that they were doing. And that's the bit that I'm starting to wonder about just now. Are people not necessarily clever, but
you've never been subprime, Chief. Don't be so hard on yourself. Don't be so hard on yourself.
Cut me in half, it says subprime.
Triple A rated. Come on.
It's a Scottish Angus beef. That you don't need the Wagyu. You got the heart.
There's definitely beef. That's for sure.
I think there's definitely less of that now.
How the institutions though are positioning themselves.
Mm-hmm.
And what's not being told, or what's not overt and transparent to the market yet.
Well, it's senior relationship manager, business development is the guy's title at the bottom of the email. It doesn't sound like that.
Wow. Yeah, that's the don't take this, please leave it model, isn't it? Rather than take it or leave it. It's they want you to don't take it, and they definitely want you to leave it.
Yeah.
Interesting. Well, we are it's 10:15. We've been going really strong today, and Will was also posting quite a few links to various different podcasts with Jay, with Adam, with more Jay, with more Adam. There's plenty of podcasts on Will's podcast about growing wealth and the current market conditions and all sorts of other things. So if you guys want to keep listening over the whole Sunday, I'm pretty sure you wouldn't run out of material there. It's been great chat. Do we want to add anything else?
Thanks to everyone for their comments as usual. Great engagement today. Really steered the discussion nicely. Thank you.
Thank you.
Really good. Yeah. Brilliant. Fantastic. Well, let's wrap up for today. And again, thanks everyone for the comments, and we'll be back next week.
Thanks, everyone.
Thanks, everybody.